Hi, this is Jeff with Fish Creek Capital. I wanted to talk today about how dividends are actually taxed. Here at Fish Creek, we focus on dividend growth portfolios. So, this is important to us and our clients because ultimately we are after cash flow. That's why we like dividends, especially dividends that are growing. But how will that impact us from a tax perspective? There are really two types of dividends. They're qualified dividends and then ordinary or non-qualified dividends. Qualified dividends are going to be taxed at 0%, 15%, or either 20%, depending upon your income. For high earners, there could be a 3.8% additional tax that is paid, but for the most part, really you're going to be around 15% on a qualified dividend. These qualified dividends generally apply to most U.S. companies, United States company dividends. Some qualified foreign companies will fit this scenario, but for the most part, any U.S. company that pays a dividend will be considered a qualified dividend. The holding period, there is a holding period requirement on a qualified dividend. You must hold the stock for 60 plus days in the 121-day window around the ex-dividend date. So that's a little complicated. Basically, that keeps you from just buying the stock, getting the dividend, and then selling the stock. So that's kind of the summary of why that holding period requirement is in place. You can reinvest the dividends, but it's important to know that in a cash account or like a normal brokerage account, those reinvested dividends will still be taxed in the year that they're paid. A lot of people don't know that. So if you have a cash account that is being paid dividends that are reinvested, which is a great idea, it's important to know that those dividends will still be taxed. Now, that doesn't happen in an IRA or a Roth IRA account. Those are tax deferred accounts, and those dividends, of course, you don't have to pay taxes on in the current year because they're retirement accounts. State taxes usually taxed at they're usually taxed at an ordinary income, but it does depend upon the state that you're in. So again, that's all just qualified dividends. It's really a little more complicated than you think. Let's talk about ordinary dividends or non-qualified dividends. Those are taxed at ordinary income rates. So depending upon your income, that could be 10% to 37%. There is no special requirement for the holding period. So that's different than a qualified dividend. But an example of an ordinary dividend might be a REIT, which is a real estate investment trust, which is you might find surprising. You'll hear a lot of advice given to invest in real estate investment trust. Well, those are not qualified dividends. Those would be non-qualified dividends, which would be taxed at your ordinary income. Certain preferred shares are taxed that way. And then there's some special dividends that can be considered ordinary dividends also. They're still taxed in the same year that they're received. So that's similar. All distributions inside a traditional IRA or a Roth IRA are taxed as ordinary income also. So that's the same. And then it does grow inside a Roth IRA. It's going to grow tax-free if the rules are met. So two types of dividends: qualified dividends, non-qualified dividends. It does make a difference, and you do want to pay attention to that when you do create your investing plan, your investing strategy. And again, I think the most important thing probably that you might not be familiar with is that a REIT, a lot of people invest in REITs. Those are not qualified dividends. They're going to be ordinary dividends that are taxed at your income level. Again, the 10% to 37%. If you have any more questions, please message me below. You can reach out at fishcreekcapital.com. I would love to help. Please like and follow, and I will talk to you soon.